Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NEWMARKET Corporation Annual Report. NEWMARKET Corporation offers a diverse range of businesses and services through its subsidiaries. At the core of its operations are the manufacture and sale of petroleum additives for various applications. These include lubricant additives for vehicles and industrial use, engine oil additives for passenger cars and heavy-duty equipment, driveline additives for transmission fluids and axle fluids, and industrial additives for hydraulic fluids and greases. In addition to these products, NEWMARKET Corporation also provides fuel additives that enhance the refining process and performance of various fuels. These services cater to a wide range of customers, including industry, government, original equipment manufacturers, and individual consumers. Furthermore, the company engages in contracted manufacturing and related services, as well as marketing anti-knock compounds. The company's geographic reach is extensive, with operations spanning North America, Latin America, the Asia-Pacific, Europe, the Middle East, Africa, India, and internationally. NEWMARKET Corporation also owns and manages a real property in Virginia, further diversifying its business interests. With a rich history dating back to 1887, the company has established itself as a leading player in the petroleum additives industry. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to increase. The stock price of NEWMARKET Corp has increased slightly over the past year due to several factors. One possible reason is the company's strong financial performance, including revenue growth and profitability. When a company shows consistent improvement in its financials, investors tend to take notice and buy into the stock, driving up the price. Another factor that could contribute to an increase in stock price is positive industry trends. If NEWMARKET Corp operates in a growing or emerging industry, it may benefit from increased demand for its products or services, leading to higher revenue and profitability. This can attract more investors and drive up the stock price. Additionally, changes in management or leadership within the company can also impact stock performance. A new CEO with a proven track record of success or a strategic plan to drive growth can boost investor confidence and lead to an increase in stock price. Lastly, external factors such as mergers and acquisitions, partnerships, or government policies can also influence stock prices. If NEWMARKET Corp is involved in any significant deals or receives favorable treatment from regulatory bodies, it may attract more investors and drive up the stock price. Overall, a combination of these internal and external factors can contribute to an increase in NEWMARKET Corp's stock price over time. NEWMARKET Corporation maintains a market capitalization of $6 billion, broadly in line with the industry peer group. NEWMARKET Corporation trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 3.18 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 1.99%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a review of the key factors that influence an organization's financial performance. Revenue growth is primarily driven by several key factors. The acquisition of new businesses has contributed to higher net sales, as seen in the specialty materials segment. Increased shipment volumes have also led to increased revenue. Additionally, adjustments to rebates or business development funds have provided a significant boost to revenue. Furthermore, the sale of AMPAC finished goods inventory was a one-time event that did not impact revenue negatively. On the other hand, revenue decline is primarily driven by several key factors. Lower product shipments and lower selling prices have led to decreased net sales in various segments, including petroleum additives, lubricant additives, and fuel additives. Unstable economies or governments in international markets have also had a significant impact on revenue, particularly in regions such as the Middle East, Asia-Pacific, Latin America, and Europe. Changes in laws and policies governing operations of foreign-based companies, currency exchange rate fluctuations, and political or economic instability have all contributed to revenue decline. In summary, revenue growth is driven by strategic acquisitions, increased shipment volumes, adjustments to rebates or business development funds, and one-time events such as the sale of AMPAC finished goods inventory. Revenue decline, on the other hand, is primarily driven by lower product shipments, lower selling prices, unstable economies or governments in international markets, changes in laws and policies governing operations of foreign-based companies, currency exchange rate fluctuations, and political or economic instability. The net income of the company experienced fluctuations between 2023 and 2025. Initially, it increased from $388,864,000 in 2023 to $462,413,000 in 2024, indicating a growth trend. However, this upward trend was short-lived, as the net income decreased to $418,747,000 in 2025. The profit margins of the company also underwent changes during this period. The gross profit margin increased from 28.6% in 2023 to 31.8% in 2024, but then decreased to 31.5% in 2025. Similarly, the operating profit margin rose from 17.9% in 2023 to 21.1% in 2024, before declining to 19.9% in 2025. The reasons behind these changes are multifaceted and complex. The company faced sudden changes in raw material prices and demand, limited supply of certain materials, competitive pressures, loss of significant customers, potential loss of U.S. government contracts, disruptions in distribution systems and production facilities, and failure of research and development efforts. These factors collectively contributed to the decrease in net income and profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. The operating cash flow has been steadily increasing over the years, with a notable jump in 2025 to $569 million, up from $520 million in 2024. This significant growth suggests that the company is efficiently managing its resources and generating sufficient revenue to cover its operational expenses. Furthermore, the total operating cash flow for the year stands at $22,274,000, which is a substantial amount, indicating the company's ability to generate positive operating cash flow. This is a crucial indicator of a company's financial health, as it shows that the business is capable of producing enough cash to cover its expenses and invest in growth opportunities. Overall, these numbers demonstrate that the company is on a solid financial footing, with a strong capacity for generating positive operating cash flow. The company's debt level has undergone significant changes over the past few years. Initially, it increased by $400 million with the issuance of 2.7% senior notes in 2021. However, this was followed by a repayment of the term loan credit agreement in full in 2025. The outstanding borrowings under the revolving credit facility also saw an increase from $77 million to $288 million between 2024 and 2025. Despite these fluctuations, the total debt has actually decreased significantly over time, from $111,936,000 in 2023 to $77,598,000 in 2025. There was a substantial reduction of $34,338,000. Furthermore, the company's debt level also saw a decrease from $971,281 in 2024 to $883,391 in 2025. In terms of interest expenses, they have increased due to variable interest rates on debt. The financing costs for the 2.7% senior notes were approximately $4 million in 2021 and are being amortized over the term of the notes. Additionally, the average interest rate for borrowings under the revolving credit facility was higher in 2024 compared to 2025. However, it's worth noting that there has been a decrease in interest on long-term debt by $916,000. Overall, while the company's debt level and interest expenses have fluctuated over time, they have generally trended downwards, indicating a reduction in financial obligations. Management is optimistic about the company's outlook, citing a strong portfolio of technologically advanced products and services. They believe that Afton provides customers with innovative solutions that improve engine performance, extend machine lifespan, and reduce environmental impact. To meet changing customer needs and adapt to a rapidly evolving market, the company will continue to invest in research and development. A key strategy is to focus on electric vehicle growth and reduce carbon emissions through new technologies. Management also emphasizes the importance of safety and environmental responsibility as core values, with initiatives such as the Actively Caring program and vision of zero improvement plans. The company expects growth in petroleum additives and specialty materials markets, driven by investments in technology, operational efficiency, and portfolio profitability. Management is committed to providing a 10% compounded return per year for shareholders over any 10-year period. To achieve this goal, they will focus on investing in technology, cost control, and operating profit margin management. The company also anticipates spending $100–150 million on capital expenditures in 2026, with a focus on improving manufacturing and R&D infrastructure. Overall, management strategy is centered around meeting changing market demands, investing in new technologies, and prioritizing safety, environmental responsibility, and shareholder returns. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $11.25 per share for the year ended December 31, 2025, with a total cash payout of $106 million in 2025. This demonstrates the company's commitment to returning value to its investors. In addition to paying dividends, the company has also authorized up to $500 million for share buybacks from 2025–2027. Although no share purchases were made during the fourth quarter of 2025, a total of $77 million was repurchased in 2025. This indicates that while the company may not have been actively buying back shares at the time of reporting, it has still utilized its authorization to some extent. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. Inventory buildup is a concern due to fluctuations in demand from defense and space programs, leading to lower product shipments and higher operating costs. The company's inventory levels have been valued at the lower of cost or net realizable value, indicating potential concerns. Furthermore, the decrease in inventory levels over time suggests that the company may be experiencing issues with managing its inventory effectively. Additionally, the high level of inventories acquired in 2024 raises questions about whether the company is holding onto excess stock. Supply chain disruption is also a concern due to the risk of distribution system disruptions, production facility disruptions, or disasters. The company's reliance on government contracts and foreign currency fluctuations further exacerbates this risk. The single point of failure represented by AMPAC's one operating facility and its dependence on government contracts also raises concerns about supply chain resilience. Overall, these concerns highlight the need for the company to address inventory buildup and supply chain disruption issues to ensure business continuity and competitiveness. That concludes the financial summary for NewMarket Corporation. Feel free to comment below, and I will be happy to answer them when possible.